A crash like this, you'll see 3 waves of crash. What we've seen is the first wave down. And of course, that's the most important one, because if it's 10 or 20%, then it may not be the beginning of a larger crash. We can always go to new high. This one was 35% on the NASDAQ, 25% on the S&P. So that 30% plus range qualifies it as yes. This looks like the first crash, which means now we're in the bounce from that crash where everybody can say, oh, it's over, and one good jobs report, okay? You know how much is job stuff? We're still catching up from COVID and stuff. So we are in a recession. All the signs point towards a recession. Everybody says it's going to be shallow. That's what the experts say every time we have a recession. Here's the truth about this thing. Let me tell you what happened during COVID. $5.1 trillion in fiscal stimulus and $5 trillion in monetary stimulus in 2 years, almost half of GDP, and we're already falling into a recession again despite that, okay? It shows what I'm saying. The economy is weak because the baby boom peaked back in 2007. We're in the weakest part of that downturn demographically, the biggest demographic downturn in history, until about 2024, still a year and a half from now before we start to recover. So this downturn is going to have to be deep to wash out all the debt and all the bubble stuff. We can't just come roaring out of this and say we're over it. This is the first wave down. We may be close to the end of this bounce. So consider, here's how it goes. A first wave crash down, 2-wave counter trend, okay? Retraced 40 to 50%. We retraced about 40% now, so this could be over soon. Then you get the next wave down. That's called the 3-wave. That should be the same size and length of this wave or more. So we're probably going to see another wave down from sometime this month into January of next year. And if the market's down into January 2023, just the January indicator would tell you the whole year is going to be down. So that'd be the next wave. Then you'll get a bounce, and then the final wave will come into late 2023 or early 2024. That's what you should expect after a bubble of this magnitude, especially one that's been stretched and stretched and stretched. The economy's never been able to wash out all this excess. We have $600 trillion now in financial assets, 6.5 times GDP globally, and that normally would be 2 times GDP in normal time. So this bubble has to unwind. That means hundreds of trillions of dollars of financial assets. What is that? Real estate, stock, bonds, commodities, gold included in there, all have to deflate back down to normal so we can come out of this. And we have to flush out bad debts, the highest debt ratios. Can't even compare the debt ratios globally and domestically to the roaring 20s and past bubbles like this. So people need to understand, this is the greatest financial asset bubble in history. There is no soft landing to this, period. There is no magic way to get out of it. Now that this thing is cracked this far, I've been telling our subscribers for months and years now, they'll come to a point where they keep stimulating, but it's not enough and the economy breaks down anyway. We are in the beginning phases of that, and it's very, very likely this is going to continue. So don't listen to all of the clueless economists that never thought this could happen in the first place and saying, well, this will be a mild recession and the worst is over. I am telling you, it is not. And you are risking your assets if you do not take this seriously. Now, all you need to be is out for about 2 years to let this happen, okay? If I'm wrong, you'll miss some minor gains after things have gone up so much that they're so overvalued. If I'm right, you're gonna save your assets while most people are gonna lose them and never get back to even again. This is once in a lifetime. This is not another recession. It's not another 20% stock crash. This is gonna be the biggest crash you have seen in your lifetime, more comparable to the 30s, not quite that bad, and that you will see for the rest of your lifetime. That's what I am saying. 86% from top to bottom. We already peaked in January 4th on the S&P and November 22nd on the NASDAQ. I see 86% to get to the bottom of the S&P a few years from now and 92% for the NASDAQ. So yes, in that 80 to 90% range. Again, you have to go back all the way to 1929 to 32 when we saw an 89% crash. They've been stimulating ever since early 2009. And every time it slows, they just up it exponentially. They printed more money just in the last 2 years of COVID than they did in all the cumulative 13 years before that. So they've been escalating stimulus, $10 trillion of stimulus in 2 years, 50% of GDP, to the point now that they have to tighten. They force themselves in a tightening cycle, and the difference between me and the government here is I'm saying the economy is so weak that this tightening is going to fail faster than they think. This tightening is not going to last long because the economy is not going to react well to it. Inflation went from 1% to 9.1% and 0 to 60. That's what kicked their butts, okay? That's what stopped this thing. How do you think you can print more money and not create inflation? The only reason it didn't otherwise, the economy was weak and the demographics were slowing, and that kept the lid of inflation. What I'm saying is they made, since they don't know what they're doing, and they don't understand the damn economy, they don't understand what's going on, they made a mistake overreacting to COVID, okay. And now that has called their hand, forced them to tighten, and if they turn around too quick on tightening, it's going to send a signal that the economy is even weaker than anybody thinks. We need to deflate this financial asset bubble so that things go back. Housing, what's the biggest problem in our economy? Young people can't afford to buy a house. You know what a house was, an everyday house was 20 years ago? $120,000. You know what it is now? $420,000. What does that do to your standard of living if you just got married and had 2 kids? Can't afford to buy a house. And if you do, you can't afford to buy anything else. And interest rates are artificially low. When they go back to normal levels, because government's pushing out, then all these mortgages and stuff are going to cost more. They have basically, we've been living in an artificial economy. You don't get something for nothing. You can pump it up for a while. Mark my words on this and shoot me if I'm wrong. Next few years, housing in the United States is going to go down 50%. You know what? People said that couldn't happen. It already went down 34%, and I predicted that, okay? Already went down 34%, more than in the Great Depression, not because the economy was worse than the Great Depression, no, it's because we didn't have a bubble back then. You couldn't buy a house with no money down, with damn near 0 rates and speculate like you could. In the roaring 20s, in that bubble boom, a house you had to put 50% down, and the longest mortgage you could get is 5 years with a balloon payment. That's what's different now. So housing had a big crash, but of course they pushed us out of it. The next crash, mark my words, 50%. Most people who got a mortgage in the last decade are going to be underwater. Banks are going to be underwater on loans, and then this thing's going to be a big mess, and they're finally going to have to write down loans. So what I tell people, here's the classic thing I get when somebody hears my friend say, "Oh, Harry, I got 2 houses. One of them's all paid for, and the other one I just got a 90% mortgage. I'm going to sell the one with the mortgage." And I'm like, no, sell the one that you got all the equity and take all your money out because it's yours. Keep the one with the mortgage, because at some point, banks are going to have to write down these mortgages because they gave people mortgage they couldn't sustain. At some point, you got to write down the debt instead of just having more stimulus and keeping the crazy game going.